I just found a stock in the robotics space that could potentially 56x in the next 5 years. But with such a high reward comes extremely high risk. I've also made some changes to my portfolio, so let's get into the details. The stock I'm talking about is Richtech Robotics with a stock ticker RR. I honestly spotted this stock a couple of months ago and didn't buy it because I thought their business model didn't have high potential. But something changed last week and went completely under the radar of the whole stock market. First of all, a bit more about the company itself. It designs, develops and commercializes service robots. While Tesla is trying to make general purpose robots that can do a wide range of tasks, Richtech Robotics is making and already selling robots designed for specific tasks like bartending, for example. Right now they offer 2 worker robots, 3 delivery robots, 2 cleaning robots and multi-purpose robots. But their main products are these 2 worker robots, Adam and Scorpion. Both of them are AI-powered robots capable of making drinks, with the AI being powered by Nvidia. Now, the most obvious reason why someone would want to buy these robots instead of hiring a human is that they can work 24/7 without breaks. On top of that, their most recent robot has an average drink production time of 1 minute, speaks 4 languages and can support up to 20 ingredients. That is what I found a couple of months ago and decided not to invest in the stock because I couldn't see how restaurants could afford to spend thousands of dollars on a relatively new robot that might end up not working properly. But I overlooked something and a major piece of news dropped last week. You see, as a restaurant or a bar, you don't have to buy these robots, you can rent them. And that provides recurring revenue to Richtech Robotics even if the actual sales of robots slow down for some reason. And the amazing piece of news that dropped on October the 17th is that Richtech Robotics expanded its agreement with Ghost Kitchens to manage 20 additional Walmart located restaurants, growing its restaurant operations model. And exactly this restaurant operations model made me buy into this stock. The company will operate 20 Walmart located restaurants in Arizona, Colorado and Texas. These restaurants will be directly managed by Richtech Robotics subsidiary Alpha Max Management with the aim of optimizing restaurant operation through robotics and AI cloud technology. And get this, each location is expected to generate between $700,000 and $2 million in annual revenue. On top of that, the company has already secured exclusive operational rights for the Ghost Kitchen at a Walmart location in Illinois and Georgia. These 22 locations would bring in a minimum of $15.4 million of annual revenue, while the company's current revenue is just $9.11 million. Now, if we assume that the company can get to its goal of more than 1,000 locations in 5 years, although they want to get to tens of thousands of restaurants, and that each location can bring in a minimum of $700,000 of revenue a year, that's $700 million of revenue a year. And if the company trades at the same PS ratio as now, it would have a market cap of $3.8 billion, while the current market cap is just $69 million, which represents a 56x potential gain. But if it has so much potential, why is it trading so cheap? Well, because the risk is also very high. First of all, the company is quite small with around 50 employees and a market cap of less than $100 million. Secondly, its stock is currently trading below $1, which means it could get delisted from the Nasdaq. Now, they could do a reverse stock split, which is in my opinion a bit less of a problem than with Luminar Technologies, a stock I covered in one of my previous videos, because unlike Luminar, Richtech Robotics has a lot more cash than that, and they seem unlikely to do a dilution right after the split. Another potential problem could be that what if these restaurants just don't bring in the amount of revenue they estimated? And as you probably assume, the company isn't profitable, so what if it can't reduce its costs in time? Because if we assume that they continue to burn $3 million a year, although that number has been increasing over the years, and they have about $9 million in cash, it would give them about 3 years before they go bankrupt. And the last thing that worries me a bit is low insider ownership of just 9%, while the company has a very small market cap. For comparison, ASTS has a 30% insider ownership. So the potential definitely is there, but the risk to get there is also very high. I have already invested the most amount of money I'm prepared to lose into very risky positions like Luminar Technologies, which is why I've decided to cut my Luminar position in half for a total profit of about $18. That way, I reduced my position in Luminar to about 2,109 shares at an average buying price of about 84 cents and bought about 2,390 shares of Richtech Robotics at an average buying price of about 72 cents. I honestly don't plan to add more to these two positions unless these stocks fall for completely unimportant reasons. On October the 15th, I deposited 1,000 euros and bought more Warner Bros. Discovery, bringing my total position to about 172 shares at an average buying price of $7.81. Aside from that, nothing really changed with the stocks I'm holding except for ASTS, which finally started rallying again due to a few important news. Firstly, we got Scott Wisniewski's interview on Bloomberg Tech TV, in which the ASTS's president and chief strategy officer stated that ASTS believes they are capable of manufacturing 6 satellites a month, that they have planned launches for Q1 of 2025, that same quarter also marks beta testing with more than 30 minutes of testing time a day, that they had successful talks with the US government, and that they won't do a dilution in this year as they have already stated before. A day after that interview, there was a non-terrestrial network summit in Las Vegas, in which Chris Ivory, ASTS's chief commercial officer, said that in 12 to 18 months they'll be able to provide mobile service that is always available and always on. Now I'm assuming that he meant only in the US, but that's still way ahead of their past schedule. He also said that they require 96 satellites for near global coverage. He then said that in order for the mobile network operators to bring the product to the consumer market, they need to have a near 100% persistence, which is why he then confirmed that the early adopters will be the US government and their first revenue will be from them. And the last thing is that 2 additional bluebirds unfolded, with the last 2 probably getting unfolded in this week. And these bluebirds are getting ready for initial commercial operations. Now, I've also noticed that Canadian Solar dropped back down to around $12 after all that China business. I have already made a separate video discussing why this stock is so undervalued, but in short, its book value per share is $40, with the company's risks being Chinese influence and high debt. Now, if I somehow find the additional funds to invest and if the stock continues trading at this level, I'll highly consider buying it. Having said all that, this is purely for entertainment purposes, as I'm not a financial advisor. And if you want to see more of my content, click on the video just popped up. If you like my content, subscribe, and thanks for watching.